All right, so welcome to another video. Today, what we're going to do is we're going to check out the best sector to invest in now or maybe in 2023. So I'm going to show you some data here as we continue to move forward and take a look at some things and just some sectors and some insights. I do want to also let you know, check out the website that we have at Traders Fly. There's a lot of freebies in there. You can also check out the live classes that we also have in that area. But there's a lot of great freebies you could download just by entering your email address. And you can also check out our Discord channel by just clicking the link in the description below. And that's where I post some charts and some support and resistance lines to watch out for. All right, so let's kick things off. We're going to go ahead. I want to show you just a couple of interesting tidbits here when it comes to looking at sectors and just looking at what's been doing really well lately, but then also like what should you watch out for as we go into the next 6 months, next year, maybe you're a longer term investor. So just some raw data here that you could go ahead and make your own decision on, hey, what kind of stocks do I want to look into? And here we're going to go ahead and look at the year-to-date change, and no magic here. The energy sector here has been doing kind of the best, and this includes stuff like the XLE. You could see it's pretty much right there, identical. So this is our energy sector. You can see has just been powering higher and doing really well, with a 28% change. Utilities is kind of next with only like 1.97 because a lot of the other stuff has just not not been doing really well. So if we look at the worst performer, it's actually technology. So from here all the way down to here, we are down approximately 25%. So here it's 22.85 exactly, but it's roughly 25% down in a big way. Let me go ahead and switch this to a little bit of a better chart for you guys so you could see it on video. Okay, so what I want to point out in this context is if we just kind of look at the raw data here, what I want to show you is if we look at kind of 2008 and just kind of look at just the data here at one of the worst ones, you can see basic materials was kind of the worst. And if we start looking at stuff like this, when we start evaluating like the worst performer, basic materials, and then look at coming off the worst year, what typically does really well, it's usually the one that's the worst performer, because stocks, what happens is when they sell off big time, then they'll snap back up the next time. Now, of course, it doesn't go year after year because sometimes it's kind of mid-year. So do keep that in mind. But what I want to show you here is just some raw data of looking at 2008, which is kind of the massive sell-off. You could see things were down 47%, 45% on the financial. Technology was 43%. But then the biggest one the next year that did really well was the 75% return, was the basic materials, which did the worst, right? Because so it got oversold, it got hammered. And then we came back in 2009 with 75% return. Technology, which was the third worst, I believe, because it's 43%. It was, let's see here, the third worst, but it did the second best, 61% back. So when you start looking at this, you got 75%, 61%, and then the next one's right under the 50. So 49% for consumer cyclical. So you could see the ones that did the worst did the best later on. So if we look at, again, another kind of worse year, let's look at 2011. Basic materials did pretty bad, 22%, and then financial services, 18%. And then what I want to see is like, hey, where do they fall in the next year? And again, keep in mind, some of this just comes down to also overlapping from the previous. But you can see it didn't do the best because financial services came out actually on top. Basic materials came in kind of like 7th here or so. But the one that did the second worst actually came out the best in 2012. Okay. So that's something to kind of watch out for, is that usually the things that do the worst, not always, but quite often do come back and push really higher. So again, just watching the data here, and let's take a look at maybe 2015 has a handful of red stuff over here. So again, 28%, and I don't think you can see it over here, but here, I'll show you. 28% is energy. Okay. And you can see it came back with about a 33% comeback. And the one that did 20%, that is our basic material, and that came back with 39%, so it actually did even better. So, but the two worst actually did the two best, right? One got a little more than the other. So as we look into this year, or even let's say the previous year here, energy did the worst and it's doing the best, right? So it's kind of fascinating to see that, it's like, hey, energy is doing so well. Yeah, but it also did the worst the previous year. So now think about it this. I want you to just kind of relate to this concept is right now technology is doing the worst. And remember, this whole world, a lot of it's related to technology. I mean, there's a huge business in technology, but it's doing the worst now. It got overvalued, right? And we're down about 22% on, from a sector index perspective. So we're down 22%. So I'm expecting stuff like technology and consumer cyclicals maybe coming out on top here coming forward. Again, take it with a grain of salt, saying, hey, there could be some selective names. It could be just certain specific stocks. But in general, technologies hit the worst. And looking at past data, the stocks that usually are hit the hardest are usually the ones that come back very strong because they get oversold, they get into value, and then they come back. That's just, the energy of, when things get oversold, they get bought out, and then eventually it just pushes that stock higher. So watch out for some technology names. I know there's a lot of stocks here that got kind of really dumped quite a bit. So when we start looking at stuff like here, and you start looking at these things, you can see stuff like, Zoom. I mean, some of these things are just down in a big way. Like if you look at the weekly, you got Zoom, you got Shopify, also technology, Spotify down. Not that I really like Spotify, but these names are pretty big. Apple's one of the few that isn't down quite a lot, but a lot of other tech stuff is. So just putting into things like Netflix, which is, you could say a media company, but it's consumer cyclicals, but it's kind of a tech company to me. So as you start looking at any of these tech things, a lot of them are down big time. And you could just go through like your big list, and I bet you could find like a ton of tech companies that are just down in a big way. So let me just show you here. Autodesk, here, another one down big time. Let's go through CRM, also down big time. What else we've got? That's I know is down fairly big. Airbnb is interesting because it's kind of like a tech company, but it's not really down that much. And then if we look at QCOM right here, quite a bit of sell-off. We've got Take-Two Interactive also down. Like you could just see a lot of these tech names are. There's Twilio for you right there, also down quite a lot, from those highs from the last year or so. You're down 72%. And then let's see what else we've got. Just give you another one or two. Spotify, we talked about. Hey, Square, kind of a tech. It's going to be in the financial sector, right? Because it's kind of financial, but it's technology too. So when you look at it, this stuff is down quite a lot, and it's 63% on that one. So it's really fascinating on all this stuff because they're down quite a lot, and I think these are the ones that. Not exactly these specific names, but in that area is kind of what you might want to take a look at and keep your eyes peeled for, because these are the names that could roar back very quickly. And just looking at the data, right? I'm just looking at kind of, hey, after a bad year, usually you get a really good year the next year. And that's just because things get oversold and dumped, and you get the shorts that pile in, and then you get the flood of buyers that step up, or the shorts having to cover. So anyways, a lot of these stocks I would just watch and be a little more careful for the risk on the upside. So if you're short these names, be mindful. I'm not saying they can't go lower, but just looking at year after year, sector by year here, just do your own due diligence, take a look at your own stuff and see what makes sense from the numbers. But oftentimes from what I found by looking at these numbers is that when you have a really bad year in a certain area, it usually typically has a pretty good year the next year. And again, some things might overlap a little differently. You might have a November that's good, and it could have actually been more percentage if you look at actually from the swing lows. But in general, year after year, looking at it, things within, the first couple of bad ones are usually the ones that are coming out and doing quite well the next year or two. So check that out. Think about it. Do your own due diligence analysis, and make use of it for yourself. All right. Well, I want to thank you so much for joining me. Enjoy the rest of the week ahead. Thanks again, and I will see you next time.